In 2008, the United States government bailed out the banks. It poured hundreds of billions of dollars into failing institutions, and in exchange, it quietly became a shareholder in companies it never actually wanted to run. Nobody in Washington was excited about owning a piece of Citigroup or General Motors. It was an emergency measure, a fire extinguisher moment, and as soon as the smoke cleared, the government unwound those stakes as fast as it could. That was supposed to be the exception. A one-time, crisis-driven departure from how American capitalism normally works. The government funds research. It buys weapon systems. It writes checks to universities and national labs. It does not, as a rule, sit on the cap table of private companies and wait for its shares to appreciate. Then it happened again. Quietly, and with far less public alarm, the federal government took a stake in Intel as part of a CHIPS Act arrangement, converting what had been framed as grant money into an actual equity position, something close to 10% of one of America's most iconic chip makers. That deal barely registered as a crisis moment. It was framed instead as strategy, as industrial policy, as the government making sure that a company central to national security and semiconductor supply chains didn't fall behind or fall apart. It raised eyebrows, but it didn't cause panic. Intel was already a known quantity, a legacy giant everyone understood, even if its recent performance had been shaky. Now, in 2026, it's happening a third time. Only this time, the target isn't a struggling bank or a semiconductor company that's been publicly traded for half a century. This time, the government has taken direct equity stakes in 9 quantum computing companies, an entire category of technology that is still, by almost every measure, unproven. Quantum computers have not yet done anything that a classical supercomputer absolutely cannot replicate given enough time and resources. The physicists who build these machines will tell you, often in the same breath, that they still don't fully understand every mechanism at play. And yet, Washington just wrote checks worth more than $2 billion, structured not as grants, but as ownership positions, into a field that even its own scientists describe as barely out of its infancy. This is where the story stops being a simple headline about government funding and starts becoming something much stranger. Because the United States didn't just decide to support quantum computing, it decided to become an investor in quantum computing. And once you frame it that way, an uncomfortable question starts to surface, one that nobody in Washington seems eager to answer directly. If the government is now picking winners in an industry defined by uncertainty, speculation, and technology that doesn't yet work at commercial scale, what exactly separates federal industrial policy from a hedge fund making a very large, very public bet? Let's walk through what actually happened, because the details matter here more than the headlines suggest. According to reporting that broke in the spring of 2026, the Commerce Department signed letters of intent to distribute $2 billion across 9 companies working in quantum computing and quantum-related hardware manufacturing. This wasn't spread evenly. GlobalFoundries, a major chip manufacturer that also plays a role in quantum hardware production, received the largest single allocation, or roughly $375 million, aimed specifically at building out domestic quantum manufacturing capacity. IBM, a company that has been working on quantum computing since before most people had ever heard the term, received a major allocation as well. Then came the smaller, more specialized players. Rigetti Computing, D-Wave Quantum, and Quantinuum each received allocations in the neighborhood of $100 million. Dirac, a lesser-known name outside quantum circles, received up to $38 million. What made this fundamentally different from a typical government grant wasn't the dollar figures, it was the structure. Instead of simply handing over funding in exchange for research milestones or manufacturing commitments, the way CHIPS Act money had often worked before, the government attached strings that gave it actual ownership. D-Wave's entire $100 million allocation was structured as an equity investment, not a grant. Rigetti and Inflection took on similar arrangements. GlobalFoundries agreed to hand over roughly 1% of the company in exchange for its funding. In plain terms, the United States government did not simply support these companies. It bought into them. It became, in a very real sense, a shareholder in America's quantum computing sector. And the market noticed immediately. Within hours of the news breaking, quantum computing stocks exploded. D-Wave Quantum closed up 33% on the day. Rigetti jumped 30%. Inflection, though not publicly traded in the same way, saw its valuation metrics rally by a similar magnitude, according to analysts tracking the deal. Even IBM, a much larger and more diversified company where quantum computing represents only a sliver of its overall business, climbed by a modest but still notable single-digit percentage. Investors read the signal instantly. If the federal government of the United States is willing to take an ownership stake in your company, that's not just funding. That's a stamp of legitimacy. That's Washington telling the market which horses it thinks are going to win the race. It's worth pausing here to note that this isn't even the first time in American history that the government has taken a direct stake in a private company during a moment of perceived crisis. Back in 1979, Washington guaranteed loans to Chrysler to keep the automaker from collapsing, And as part of that arrangement, the government received warrants that allowed it to purchase Chrysler stock. When Chrysler recovered years later, the government exercised those warrants and actually turned a modest profit for taxpayers. A rare success story that gets cited to this day by anyone arguing that government equity positions can work out fine under the right circumstances. But Chrysler was a known, mature business, making cars people already understood and already wanted to buy. It wasn't an unproven scientific frontier where the core technology itself remained years away from commercial viability. The quantum computing bet is a fundamentally different animal, and comparing it to Chrysler, or even to the more recent Intel deal, risks flattening some very real differences in risk profile. Which brings us to the uncomfortable comparison that a growing number of analysts, economists, and yes, everyday investors have started making. Warren Buffett spent more than 60 years building his reputation on one core principle. Never invest in a business you cannot understand. Stay inside your circle of competence. Don't chase hype. Don't gamble on speculative technology just because everyone else is excited about it. Buffett became one of the greatest investors in history precisely because he refused to do what Washington just did. He avoided the dot-com bubble almost entirely, not because he predicted the crash with any precision, but because he simply didn't understand the businesses well enough to justify putting Berkshire Hathaway's capital behind them. He famously stayed away from most of the tech sector for decades. He has been openly skeptical of speculative asset classes throughout his career, and even now, in his mid-90s, preparing to step back from Berkshire Hathaway's day-to-day leadership, his investing philosophy remains remarkably consistent. Understand what you're buying. Buy quality, be patient. Avoid what you can't explain in simple terms to someone else. Buffett has also long emphasized the importance of what he calls a margin of safety, the idea that you should only invest in a business when the price you pay leaves enough room for error, enough cushion in case your assumptions turn out to be wrong. That principle assumes you can reasonably estimate a business's intrinsic value in the first place. With quantum computing, intrinsic value is almost impossible to pin down with any real confidence, because the industry hasn't yet demonstrated the kind of consistent, scalable revenue generation that would let anyone build a credible valuation model. Analysts can estimate a potential future market size for quantum computing, and some of those estimates run into the hundreds of billions of dollars over the coming decades. But potential market size and actual demonstrated business value are two very different things, and Buffett has always been far more interested in the latter. Now look at what the federal government just did. It took direct equity positions in 9 companies working in a field where the underlying physics is so complex that a Nobel Prize-winning physicist once said, only half joking, that nobody actually understands quantum mechanics. It bet billions of taxpayer dollars on technology that most experts agree is still 5 or more years away from any kind of broad commercial viability. It made this bet not after careful Buffett-style due diligence conducted over years, but in a matter of months, driven by concerns about competition with China and a broader push to make sure the United States doesn't fall behind in what many consider the next major computing revolution after artificial intelligence. In other words, the government did the exact opposite of what the most successful investor in modern history spent his entire career telling people to do. And that's the Buffett problem nobody in Washington seems to have fully accounted for. Not a legal problem, not immediately. Not even necessarily a political problem, at least not yet. It's a credibility problem. It's a question of whether the federal government, an institution that has never functioned as a disciplined, patient, value-oriented investor, can actually behave like one when it decides to start picking winners in speculative markets. To understand why this matters, you have to understand what makes Buffett's approach so different from what a government agency is capable of doing. When Berkshire Hathaway buys a stake in a company, that decision goes through layers of financial analysis, historical performance review, and long-term thinking that spans decades, not election cycles. Buffett has held Coca-Cola since 1988. He has held American Express for even longer. His approach rewards patience, discipline, and a willingness to walk away from anything that doesn't meet a very specific, very conservative set of criteria. Buffett doesn't chase headlines. He doesn't invest because the technology sounds exciting or because ignoring it might make the country look like it's falling behind a geopolitical rival. He invests because the math works, because the business is understandable, and because the fundamentals justify the price. The federal government, by contrast, operates on almost the opposite set of incentives. Political administrations change every 4 years, sometimes every 2, and each new administration brings different priorities, different levels of enthusiasm for industrial policy, and different tolerances for risk. There is no equivalent of Buffett's famous circle of competence inside a federal agency, making these decisions in a matter of months, under pressure to appear competitive with China's own aggressive investments in quantum technology. There's no 50-year track record of disciplined capital allocation to draw on. There's urgency, there's geopolitical anxiety, and there's a strong incentive to be seen as doing something bold even if the underlying technology hasn't proven itself yet. This is precisely why legal experts and financial analysts have started raising red flags about the structure of these quantum deals, separate from whether the underlying strategic goal makes sense. One analysis published shortly after the announcement pointed out that the equity condition attached to the funding raises real legal and financing questions that go well beyond the political optics. The Commerce Department wants a minority, non-controlling stake in each of these companies as a condition of releasing the money, which represents a meaningful departure from how quantum computing companies have traditionally been funded. For years, these firms lived in the space between scientific promise and commercial patience, relying on venture capital, partnerships with national laboratories, interest from the Department of Defense, and the hope that one major technical breakthrough would eventually unlock a much larger market. Now suddenly, the government is stepping in as something closer to an institutional investor, and the legal authority underpinning that shift hasn't been fully tested or explained. The core question isn't really whether quantum computing deserves federal support. Most people across the political spectrum agree that it probably does, given how central computing infrastructure has become to national security, economic competitiveness, and the broader technology race with China. The real question is whether taking equity stakes, rather than simply providing grants or research funding, is the right mechanism to deliver that support. Grants come with fewer entanglements. If a company fails, taxpayers lose the money, but the government isn't left holding a depreciating stock position in a business that quietly collapsed. Equity stakes are different. They tie the government's financial fortunes directly to the success or failure of individual private companies, which introduces an entirely new layer of risk, one that traditional appropriations and grant-making processes were never designed to manage. There's also a subtler issue buried inside this story, one that touches on something Buffett has warned about for decades: concentration risk. When you take a position in a business you don't fully understand, in an industry where the technology itself is still evolving rapidly, you're not just risking capital. You're risking your ability to correctly judge which companies will actually succeed. 9 companies received funding in this round. It's virtually certain that not all 9 will thrive. Some may pivot dramatically. Some may get acquired. Some may simply fail to deliver on their technological promises within a commercially reasonable time frame. When a venture capital firm makes those bets, spreading risk across a portfolio while accepting that most individual investments will lose money, that's standard practice. It's built into the model. But when the federal government makes those same kinds of bets using taxpayer money and attaches its name and credibility to the outcome, the stakes look very different. Failure isn't just a financial loss. It becomes a headline, a political talking point, potential ammunition for critics who argue the government has no business behaving like a venture capitalist in the first place. And this is where the comparison to Buffett becomes almost painfully precise. Buffett has openly criticized speculative technology investing throughout his career, describing much of it as gambling dressed up as investing. He has specifically cautioned against chasing trends simply because everyone else is excited about them, warning that the herd mentality driving speculative bubbles almost always ends the same way, with early winners cashing out and later entrants left holding losses. Quantum computing stocks have shown exactly this kind of speculative behavior throughout 2025 and into 2026. Prices have surged on vague corporate announcements, on rumors of government talks, on speculation rather than demonstrated commercial results. One widely cited example involved a major bank announcing a broad, non-specific commitment to invest in emerging technologies, a category that included quantum computing, alongside several other unrelated sectors like advanced manufacturing and defense technology. Despite the announcement containing no specific dollar commitment to any individual quantum company, quantum stocks across the board surged anyway, illustrating just how much of the current enthusiasm is built on anticipation rather than proven results. This is exactly the kind of environment Buffett has spent his career avoiding. And yet, it's precisely the environment the federal government just chose to wade directly into, not as a cautious observer, but as a direct equity participant, timing its entrance right as speculative fervor around the sector was already running hot. If Buffett's investing philosophy has one enduring lesson, it's that timing driven by fear of missing out rarely ends well. Buying into hype, even when the underlying technology might eventually prove genuinely transformative, often means paying inflated prices for uncertain outcomes. Washington's quantum stakes were announced and structured during a period when quantum computing stocks were already experiencing dramatic, speculative-driven rallies, which raises an uncomfortable possibility. The government may have effectively bought in near the top of a hype cycle, using taxpayer money in a sector it has little institutional experience evaluating. None of this is to say the strategic reasoning behind supporting quantum computing is wrong. There are legitimate, serious national security arguments for wanting the United States to maintain leadership in this field. Quantum computers, if and when they mature, could eventually break many of the encryption standards that currently protect financial systems, government communications, and critical infrastructure. This is precisely why federal agencies have already been pushing for a broader migration toward post-quantum cryptography standards, preparing for a future where today's encryption might become vulnerable. China has been investing aggressively in its own quantum research programs, and losing the race for quantum supremacy could carry real consequences for national security, economic competitiveness, and technological independence for decades to come. Nobody serious is arguing that the government should simply ignore this technology and hope for the best. The debate isn't about whether to act, it's about how to act, and specifically, whether direct equity ownership is the wisest mechanism for that action. Critics argue that grants, tax incentives, and public-private research partnerships could achieve similar strategic goals without exposing the government to the volatility, legal ambiguity, and political risk that comes with owning actual shares in speculative companies. Supporters counter that equity stakes give taxpayers a chance to actually benefit financially if these companies succeed, rather than simply writing checks with no upside if the technology eventually pays off. Both arguments have merit, which is exactly why this story isn't a simple, one-sided controversy. It's a genuinely difficult policy question, one that touches on decades of debate about the appropriate role of government in private markets. What makes the current moment especially notable, though, is the pattern this fits into. This isn't happening in isolation. The quantum computing deals arrived after the government had already taken a stake in Intel through the CHIPS Act, and after it had made moves to secure domestic rare earth mineral supply chains through similar ownership arrangements. Taken together, these deals suggest something bigger than a one-off policy experiment. They suggest a deliberate, if not always openly stated, shift toward what some analysts have started calling a government as shareholder model, where Washington increasingly positions itself as a direct stakeholder in industries it considers critical to national security and economic competitiveness, rather than simply regulating or funding those industries from a distance. Whether this represents a smart evolution of industrial policy or a dangerous departure from how American capitalism traditionally functions depends largely on who you ask. Free market purists warn that this approach risks distorting competition, propping up companies that might not survive on their own merits, and blurring the line between government oversight and government ownership in ways that could create long-term conflicts of interest. If the government owns a stake in a company, does it still regulate that company with the same objectivity? If a competing firm without government backing struggles to raise capital because investors assume the government-backed companies have an implicit advantage, is that a healthy market outcome or an artificially skewed one? These aren't hypothetical concerns. They're the exact kinds of questions that arose during the 2008 financial crisis bailouts, and they're resurfacing now in a very different context. Supporters of the approach, meanwhile, point to specific historical precedents where direct government investment paid off handsomely for taxpayers. The government's investment in General Motors during the financial crisis, while initially controversial, ultimately helped stabilize an industry that employed millions of Americans, even though the government eventually sold its stake at a loss overall. Advocates for the quantum computing stakes argue that even if some of these 9 companies fail, the strategic value of maintaining a competitive quantum computing ecosystem inside the United States, rather than ceding that ground entirely to China or other geopolitical rivals, justifies the financial risk. From this perspective, treating these investments purely through a Buffett-style profit and loss lens misses the point entirely. This was never meant to be a value investment. It was meant to be a strategic one, where national security considerations take precedence over traditional investment discipline. But that argument, while reasonable on its face, doesn't fully resolve the tension at the heart of this story. Because even if the goal is strategic rather than purely financial, the government still chose to structure its involvement as direct equity ownership, subjecting taxpayers to the same market volatility, valuation uncertainty, and speculative risk that any private investor would face. If the goal was purely strategic, purely about ensuring domestic quantum capacity exists regardless of individual company outcomes, a grant-based or contract-based funding model could have achieved much of that same strategic goal without exposing the government's balance sheet to stock market swings. The decision to take equity, specifically, suggests that somewhere inside this policy, there was also an expectation, or at least a hope, of financial upside. And that's precisely where the Buffett comparison becomes unavoidable. You don't take equity unless you believe on some level that equity will be worth something. And believing that requires exactly the kind of confident, informed judgment about a business's future prospects that Buffett has spent 60 years arguing most people, including apparently governments, simply aren't equipped to make reliably in fast-moving, poorly understood industries. So where does this leave the broader quantum computing strategy heading into the rest of 2026 and beyond? For now, the market has responded enthusiastically. Share prices for the companies involved have climbed, and the political framing around these deals has emphasized national security and competitiveness rather than financial speculation. But the underlying tension hasn't gone away. Legal experts continue to raise questions about the authority behind these equity conditions, questions that could eventually face challenges in court or in Congress as the details of these arrangements become more widely scrutinized. Financial analysts continue to point out that quantum computing, as a commercial technology, remains years away from proving it can generate the kind of revenue and profitability that would justify current valuations, government-backed or otherwise. And skeptics continue to draw the same uncomfortable parallel that started this entire conversation. The United States government, an institution with no track record of disciplined, patient, value-based investing, just made one of the largest direct bets on speculative technology in its history, doing precisely what Warren Buffett spent his entire career telling investors never to do. There's one more layer worth mentioning before we close, because it speaks to how quickly the political narrative around these deals shifted. In the days before the equity stakes were confirmed, a Commerce Department spokesperson explicitly told reporters that the government was not currently negotiating equity positions with any quantum computing companies, directly contradicting reporting from major outlets that said talks were already well underway. Within weeks, that denial was overtaken by the actual announcement, letters of intent signed, dollar figures confirmed, equity structures made public. That kind of whiplash, a flat denial followed almost immediately by confirmation of the very thing being denied, only added to the sense that this policy was moving faster than the institutions responsible for explaining it could keep up with. Maybe this bet pays off. Maybe quantum computing matures faster than expected. Maybe these 9 companies become the backbone of a new computing era. And maybe, years from now, this moment gets remembered as the point where Washington got ahead of a technological revolution instead of playing catch-up. Or maybe some of these companies stumble. Maybe the technology takes longer to mature than anyone currently expects. And maybe taxpayers end up holding equity positions in businesses that never quite live up to the promise that justified the initial investment. Nobody knows yet which outcome is more likely, and that uncertainty is exactly the point. Buffett built his entire reputation on refusing to make bets he couldn't confidently evaluate. Washington just made one of the biggest bets in recent memory on a technology almost nobody fully understands, using taxpayer money under intense competitive pressure and without the decades of disciplined analysis that typically precedes decisions of this magnitude. That's the Buffett problem nobody in Washington saw coming. Not a scandal, not a crisis, at least not yet, but a quiet, uncomfortable contradiction sitting at the heart of America's new quantum strategy. The government that regulates markets, that oversees financial institutions, that has spent decades warning ordinary citizens about the dangers of speculative investing, just became one of the biggest speculative investors in the country's most uncertain emerging technology. Whether that decision looks brilliant or reckless in hindsight depends entirely on what quantum computing actually becomes in the years ahead. And for now, all anyone in Washington, on Wall Street, or anywhere in between can do is watch, wait, and hope the government's first real experiment with playing Buffett turns out better than the history of government stock picking would suggest it usually does.